Well, welcome to our very first podcast, a conversation between experts looking at challenges and potential solutions for our clients. Today, we're going to have a look at giving when a client may have tax liabilities in both the US and the UK, typically where they are US expats living here in the UK. For this inaugural panel, we are delighted to welcome Graeme Privett, Riches and Rachel Steeden. Graeme has been a partner at Rawlinson Hunter since 2013 and advises on a wide range of personal tax issues for both UK and non-domiciled individuals, including those with complex and substantial non-UK interests. He is experienced in working together with tax advisors in other jurisdictions and in particular in the United States. Hi, Graeme.
Morning, Hannah.
Good morning. John works with family offices on a cross-border basis and deals with structuring for UK residents and resident non-domiciled families. We're very pleased to say he is a trustee of Stewardship America, a charity serving those who have the challenges of dual tax liabilities. Good morning, John.
Good morning, Hannah.
Rachel is the legal advisor at Stewardship. Rachel came to us with 10 years of experience advising private clients and charities. She now works primarily with the philanthropy services team and helps our major donors to make complex gifts efficiently and tax effectively. Good morning, Rachel.
Morning, Hannah.
So without further ado, I'll hand the conversation over to John, who's going to lead the way for us. John.
Thank you, Hannah. Yes, good morning. Well, I guess where we're starting this morning is with, as we've heard, the situation of clients who might find themselves having to navigate the choppy waters of two tax systems. And you would think that in that area that charitable giving would be perhaps one of the more straightforward areas, because every government likes to encourage its citizens to give effectively to charity. Well, unfortunately, it's not quite that simple. So if we think about the situation of a US expat living in London, they'll probably be familiar with the idea of making a tax effective gift to offset against, say, their UK salary. And they'll probably be looking, by and large, maybe to take advantage of gift aid on a cash donation to a charity that they would like to support in the UK. So why is this an issue? Well, I think that the main point we have to bear in mind here is that what is charitable for UK and US purposes in terms of an eligible charity is not always the same. And so in a situation where that individual gives to a regular UK charity, if I can call it that, without further planning, then he could well find himself, or he or she could find themselves in a situation where that gift is effective to offset against their income tax liability in the United Kingdom, but it may not have an equivalent impact so far as their US tax liability is concerned. And that obviously creates a trap for people who are unwary in this area. So I think, Graeme, you were going to just give us a bit of an idea about how people might navigate those choppy waters and find a way through the maze.
Yes, good morning. Yes, this is quite a common issue where individuals are earning in the UK, and the UK has primary taxing rights over their income, and they rightfully look at UK-based charities to utilise gift aid, and that works quite well for me. Domestic UK perspective, though, with a US citizen living outside the US, they're still responsible for filing and preparing tax returns, reporting their worldwide income and gains, and therefore, where they make a donation to a UK charity, the US will not give you a deduction for that, and therefore, ultimately, they're left in a position where, yes, they're getting UK tax relief, but they're not getting US tax relief. And so the solution is a structure that allows both UK and US tax relief to be given. So it qualifies as a charity from a UK perspective, but also qualifies as a US charity under 5013 of the code. So that allows US citizens living outside the US to not only get their local tax relief, so here in the UK, but also the US relief.
Graeme, can I just ask you this? So I think the way my understanding of this works, and I guess I should understand it as I'm a trustee of one of these charities, is that the structure of the charitable arrangement is one where you have not trust but companies. So you have a US company with a UK subsidiary, and my understanding is the way it works is that for US purposes there's a check the box or a flow through election, so that when the donor makes the gift in the UK, the US tax authorities just look at the gift into the parent charity, even though the funds are received into the UK entity. And so it's a kind of situation where it's a sort of stacked structure with two charities, one on top of each other as legal entities, but where the gifts are simultaneously treated as giving you effective tax relief because of that flow through treatment for US purposes. Is that broadly correct?
Yeah, that is correct. Yes. So what you're doing is making a donation to something that the US domestically sees as a public charity, but from a UK perspective, it flows through to the UK entity, and you qualify for gift aid in that entity as well.
Okay. Can I ask Rachel a question here then? Because Rachel, what if the target recipient of this amount is actually not someone in the UK or the US, but it's somebody in another jurisdiction, maybe somewhere in Africa or some relief project that the individual wants to support? Is that okay for a gift into this dual qualified charity? Does it work, or is it only for money that's spent in the UK and the US?
Thanks, John. That's a great question. Yeah, so in principle, these structures can give to charitable causes anywhere around the world, but there is dual compliance to do. So the recipient in Africa, for example, needs to qualify as an eligible charitable purpose for US purposes, and you'd either be having to get an equivalency determination for the US recipient, sorry, the African recipient, confirming that it's equivalent to a US public charity, or you have to do an exercise of expenditure responsibility where the trustees of the dual qualified structure have to follow through very carefully and check how the money's spent and check it's all spent in a way which is acceptable under US law. In addition, you have to look at the UK rules on overseas giving in terms of HMRC rules and also Charity Commission rules, which again require you to look quite carefully at eligibility under UK law and follow through reporting to make sure that the money's been spent correctly. So it's absolutely possible, but it does need people who know what they're doing under both sets of rules.
Okay, thank you. And Graeme, I think I heard that there was some extra advantage of giving in 2020 so far as US giving is concerned, because I know in the UK we don't have limitations. You can offset up to 100% of your taxable income, subject to obviously having enough to pay the gift aid. But what's the position in the US in 2020?
Yeah, so typically giving to a public charity, you were restricted in terms of the amounts that you could gift, and that was 60% of what's termed as your AGI, or adjusted gross income. That basically means your taxable income before certain adjustments are made. As part of the coronavirus relief package that was introduced towards the end of March 2020, there's a temporary increase in the amount of cash gifts that an individual can make to a public charity. So that's been moved up from 60% to 100% of their adjusted gross income only for 2020. Now, obviously at the time of recording, that may well go up, and it's something that we'll know probably towards the end of the year or early next year, and that might stay for 2021 depending on what the situation is. But if an individual wants to make a sizable gift, they can still use the 100% in 2020, and if they don't take all of their tax relief, they can carry that forward still for a period of 5 years. So it is a mixture of providing immediate relief, a higher amount of immediate relief on cash gifts, but also the ability to carry that forward if an individual was minded to do that as well.
Okay, great. And Rachel, to that extent, by giving a donation, if somebody said, well, this is the year I want to make an effective donation like that, is a gift into Stewardship America valid for that purpose as a public charity, the type that Graeme's been mentioning?
Yes, so Stewardship America is set up exactly as Graeme has described. So we have a parent US charity, which is recognised by the IRS as a public charity, with a subsidiary UK charity recognised by our tax authorities for gift aid purposes, which has done this check the box flow through election, so that when I make a gift to Stewardship America UK, it is eligible for gift aid in the UK, and it's also eligible for a federal tax deduction. So yes, we're set up in exactly that way. You were asking earlier, John, about gifts to jurisdictions outside the US and the UK. That's one of the real strengths of Stewardship America, that we are part of something called the TrustBridge Global Network of donor-advised funds, and we can use our partners in that network to send funds efficiently across the world, and with local partners helping with the due diligence that's required under US and UK rules, so we can really help donors to get some comfort there.
Great, thank you. And what about, we've been talking mainly about income tax relief, Graeme, but what about inheritance tax and estate tax? Because I know that's also a concern for somebody who's in both tax systems.
Yeah, so for domestic UK purposes, a gift to a charity would not be one or a qualifying UK charity, and currently includes EU as well within that, but we'll see how that may or may not change post-Brexit. But a gift of that nature would not be regarded as what's termed as a potentially exempt transfer, so would not be an inheritance tax event. So it's an effective way to reduce the size of one's estate. The benefit of doing that is that you get effectively the same treatment in the US. So if you look at your balance sheet, you were making a sizable donation to a US qualifying charity as well, so qualifies both UK and US, then you effectively get the same treatment that you also your estate for federal estate tax purposes is reduced by the amount of the gift as well. So it's effective from an estate planning perspective, both in the UK and in the US.
Great, so it ticks both boxes. That's good to hear. And we've been talking mainly about cash gifts, but what about the situation, because obviously some people maybe think, well, most of my wealth is tied up in shares or something that's standing at a gain. Are there opportunities there, Rachel, to kind of take advantage of in-kind gifts in the same way we've heard of cash gifts using this structure?
Yes, absolutely. So something we've seen within Stewardship America is, for example, business founders who have floated their businesses and then got listed shares that they might want to give to charity once their founder's lockup period has expired. As you'll know, John, there are some really fantastic tax reliefs under UK law. If you give listed shares, you can effectively take the whole market value of those shares off your UK taxable income that year. I'm going to ask Graeme to talk to us about how that works in terms of the US relief. That's not my expertise.
Yeah, so from a US perspective, there's still the effective 60% limit to such gifts. So it's 60% of your adjusted gross income in the year. But again, you can carry that forward if you want to do so. One of the benefits is that you get the same lineup of tax reliefs between the UK and the US. So any capital gain that you have pregnant within the assets itself, the shares themselves, will not be subject to either UK or US capital gains tax. So the charity will be able to benefit from that.
So, Graeme, just taking an example then, on the carry forward, so let's say that I've got this windfall situation of say £250,000 worth of shares that are standing at a material gain, but my income is AGI is 50,000. If I give all of those shares in one go, can I carry forward 50,000 for the next 4 years if in terms of my cap or of what is eligible in future years, or how does that work in terms of the carry forward?
Yeah, so that that can be carried forward, but I think care and attention needs to be had, because obviously you've got UK and US liabilities knocking around as well. So one of those situations is that you don't want to, you would want to make sure, certainly from if your primary taxing jurisdiction over, for example, your employment income or your self-employment income is the UK, then I think you would start with your UK position, look at that, and then determine from a US perspective how the knock-on effect of making significant significant gain like that would affect your US return. So what you don't want to do is have a situation where you get all your UK tax relief only to find that you're not getting quite the same position in the US. So I think it's a case of marrying the two returns up and ensuring that you're getting the relief that you want to get.
And the fact that the two tax years are obviously not synchronized because of the April the 6th to 5th running period in the UK, does that create sort of traps then, from what you're saying, in terms of the year of deduction, or is that navigable with the advice?
Yeah, so that is navigable. I think it can be a bit of an opportunity. So bear in mind, when you make a cash gift in the UK, you can carry back that cash gift and treat it as if it were made in the previous tax year by filing an election. You can't do that for gifts of stocks and shares. So that's an important planning point. The other point with that is that you would marry that. So you could, if you had a particularly large gift, you would split it across 2 tax years. So you could carry some back and leave some in the current year. But again, that's needs some careful planning to ensure that you don't end up overdoing the carryback, for example, and end up with more gift aid being claimed than the actual amount of UK tax that you're due. And therefore, I normally advise that it's better to prepare, certainly in a very final draft, a UK tax return for that individual for the year ending 5 April 2020 in this case, to understand the full effect of making a carryback claim, because I think that can be a trap for the unwary.
Sure. So this is the kind of perfect time of the year then for giving, is it? Because if you're looking at your carryback for UK purposes and everyone's getting their tax return to April 20 ready, but you're looking at getting an effective gift for US in the last quarter, then in fact giving in October, November, December is the sweet spot, is it, from that perspective?
Indeed it is. And also I think that US individuals, certainly when we're back in the US, would be having these types of conversations with their local tax advisors and tax preparers about what donations they might want to make, what the effect would be on their US returns for that year as well. So it's not an unusual conversation to have. Obviously, from a UK perspective, we'd be driven by 5 April, but particularly in relation to charitable donations, the flexibility of the carryback is something that shouldn't be overlooked.
Yeah, brilliant. And what about, here's a bit of crystal ball gazing for you, Graeme. If tax rates go up for capital gains tax, then presumably the ability to offset the capital gain becomes even more valuable, does it, in the future with non-cash gifts?
Yeah, so at the time of recording this, so I'm obviously conscious that people might listen later on and then say that I got this wrong. There is talk, if Biden is elected as president, there will be a leveling up or bringing up of certainly capital gains tax rates in the US. So at the moment, they are domestically at 20% at federal level and potentially open to 3.8%, what's called net investment income tax. There is talk about bringing that up to an individual's marginal rate, which is currently anything up to 37%. So I think with an increased capital gains tax rate, the gifting of shares to charity becomes even more valuable, and the tax reliefs to which that are available to those individuals is even more important.
Great.
Thanks, John and Graeme. I wonder if in our last few minutes we could just circle back around to the topic of donor advised funds. John and Graeme, I'm sure when you're advising purely UK clients who are making a very substantial gift, perhaps several million, you're talking to them about the relative advantages of setting up their own charitable foundation or potentially using a donor advised fund charity such as Stewardship. I think it's a little bit different for people who are US, UK, and really it's going to be quite unlikely that they would want to set up their own charitable foundation rather than wanting to use a dual qualified DAF such as Stewardship America or others. Now, obviously, that's partly just because when you set up your entity, you've got to go through 2 registration processes. Been there, done that. It was pretty painful, but it's also because of the concept in America that we don't have in the UK of private versus public charity. Graeme, I wonder if you could just explain for us briefly what that means and why it means that most of our dual qualifying clients will want to use a DAF rather than their own foundation.
Yeah, so the US has a policy distinction between a private and a public charity. So at its most basic, a private foundation tends to be one that a member of a family has set up or a group of family members have set up, and very much designed to fulfill the charitable donations of that family group. Now, on a practical level, we talked about 60% of an individual's adjusted gross income being available on a public charity. That's reduced down to 30% for a private foundation. So there is a tax benefit by using a public charity for that. And so ultimately, anything that from a US perspective is seen as a public charity means that the individual is able to gift more and get tax relief for that gift.
Yeah.
Thank you, Graeme. That's really helpful. John?
Yeah, Rachel, I'm a big fan of donor advised funds. I think what I've seen increasingly in recent years is obviously, as you kind of slightly referred to, the bureaucracy around forming charities and having them regulated. Everything is more regulated, and so for clients from a standing start wanting to look at creating their own charitable foundation, there are lots of hoops to jump through, even if you don't have this dual deduction point that we've been discussing. And also the idea, if you want to involve people, that they will have to go on as a charity trustee and be subject to all those regulations, is meaning that having a donor advised structure where you have at a practical level the same degree of assurance around how the funds are going to be applied. You get to be involved in the fun bit of deciding how to give it away, but other people such as Stewardship or other providers can do all the due diligence and all the administration. I actually think that this is increasingly popular, and I guess, Graeme, you tend to see more donor advised structures in the US than we do in the UK, but it seems to me that the UK is sort of catching up fast.
Yeah, certainly. I think that tends to be the case, where I think the US has a longer history with these types of funds. I think that the UK has rapidly adopted them, and I think the reason for that mainly actually is the number of US citizens here. It's interesting that a lot of them are looking for this now dual qualifying option. So that's sort of driven us forward a bit in the UK to think about this as well. So yeah, absolutely, I think that's entirely correct.
John, we've been doing some interesting work with you recently on the concept of donor advisory boards, so that within our donor advised fund, clients have a way to bring in the wisdom of their friends or perhaps involve the next generation, but without asking those people to take on the legal duties of trusteeship. Could you tell us a bit more about that?
Sure, yes. So I think this is a kind of, I would say, a key flexibility of donor advised funds, as you mentioned, Rachel, that one can formalize the role of the founders of the structure as the donor advisory board, but it's possible to bring in your children, trusted advisors, friends, as you say, as part of a wider group of people who have a meaningful role in deciding how donations are made. And I think for many clients that I work with, although we're talking obviously about lifetime planning, this is also a big plus if they're thinking about estate planning on death, because then if you have a structure that's functioning and that everybody understands, then being able to make a charitable gift on death to this structure, you're not reinventing the wheel, because you've got a good viable structure with appropriate governance. So I think they are, seen as very much a tool for involving one's children in particular in philanthropy. I think they're an excellent tool for that.
Thanks, John. We're so pleased to have you on the board of Stewardship America. If I might just say a little word about Stewardship America in particular. We're a Christian charity, but very happy to serve donors of any faith background. We're able to give to Christian causes, but also to general charitable purposes such as health, education, relief of poverty, international development. So yes, the chances are we will very much be able to support your favourite cause. The Stewardship America service is managed by Stewardship's philanthropy team, who are used to working with major donors and working closely with them to support them in their giving. We find that many of our donors have more giving capacity than time or relational capacity, and so we do our best to take the administrative burden off our donors and leave them with the joy of giving, supporting them in whatever ways we can. As we've already mentioned, we're very happy to take both cash and non-cash gifts, and indeed legacy giving as well. So if you would like to find out more about Stewardship America, please just get in touch with us. Now I'm going to hand back to Hannah to close off the discussion.
Thank you all so much for such a rich and interesting conversation. We hope this is the first of many, and we'll look forward to hearing any comments or feedback. Please do get in touch if you have any further questions.